have a great panel assembled here today with Suzanne Bach, Scott Peper, and Dylan Burns. So I'm going to kick it off by letting you guys have the floor and introducing yourselves. And I want you guys to tell us, a little bit background about yourselves, but then also share something that we couldn't have read in your bio. So something interesting about yourself that we just would not have known.
Trick question.
That's the only trick gotcha question, guys. So we'd love to hear it.
All right, I'll go first. I'm Suzanne Bach. I lead the tax practice at Saltmarsh, Cleveland Gund, which is a regional size firm out of the Panhandle. We do, we're full service. We've got M&A, trust and estate, our wealth advisory practice. We do insurance, we do taxes, we do it all. We could do your plumbing if you if you don't care about it. I owned a pizza shop, so that would be the part you wouldn't find in my bio.
That's awesome.
I was young and I thought, heck, I want to own something. And it was either ice cream or pizza because those are my two favorite foods. And so I said, well, pizza is cheaper than ice cream. And so pizza has very good margins, in case anyone knows or cares. So yes, I bought a pizza shop when I was 19. I second mortgaged my house. So I'm very familiar with cash flow issues.
What is margin?
It's about 55%.
Wow.
Yeah, 60 depends on who your people are. But if they're giving away cheese, like it's crazy. Cheese is most expensive. So yeah, the price of cheese was like, my contractors always pay attention to the price of lumber. If you're in pizza, you pay attention to the price of cheese.
I wouldn't have either.
No. Suzanne, what was
cheese
the
is the
name?
biggest expense. Yeah, it was the pizza girl.
I love that. That's awesome.
Yeah, because nobody expects a 19-year-old girl to own a pizza shop.
No.
So my logo was like a little pizza girl, like this, holding the pizza. My brother did my logo. I mean, I was 19, so my brother was my marketing department. But it was super fun. I miss it actually all the time. I don't miss the hours. It was worse than public accounting. And it was, in the restaurant business. God help any of you in the restaurant business. But yeah, it was tough. But it was so fun. And I do miss it. So yeah, that would be my one thing, I guess.
That's pretty cool. I'm Scott Peper. I'm CEO, one of the co-founders of Mobilization Funding. We do short-term cash flow lending for commercial contractors, primarily manufacturers, other small businesses. The way I like to frame it is, think of you don't need an equity partner, but you have a lot of opportunity and you need access to some cash that is otherwise incongruent to what a traditional bank would want to do. And so we've gotten good at figuring out how you want to execute it and help you get money when you need it up front, but pay it back inside that model, inside that project, or when you're paid. So some fun fact that wouldn't be in my bio, I used to sell timeshare, was my first sales job. Yeah, which everybody can cringe. That's pretty bad.
That's tough.
I didn't necessarily enjoy it.
Were you like the top sales guy?
Well, there's a story to that. I was there for about 2.5 years. For 6 months, I sold absolutely nothing and made no money, and I was terrible at it. I was good at making friends, but I didn't sell anything. And then I got good at making friends and maybe asking people to buy it. And then I got good at selling the sales presentation and realized this is a terrible product, but I hate feeling so good at even giving it to people. And good would be like, if you took 100 presentations and you sold like 18 of them, you'd win like all the awards. And that didn't feel good either. So, that was it. And so then I left that and went into and started a health and fitness company when I was 22 with a buddy of mine.
That explains this challenge thing that you make all your people do.
I don't make anybody do it, but I do have a standing offer that if anyone completes and finishes 75 hard on our team, they get $1,000 in cash.
Wow.
Which is their own program. You don't have to do it.
What if you aren't employed by Mobilization?
Depends. I guess if you had a tangential way of making an impact, maybe we could negotiate something.
Nice. Well, I'm Dylan Burns. I work with BKS Partners. We are a full-service brokerage firm handling private risk, personal lines, commercial property and casualty, as well as employee benefits. I primarily focus on the property and casualty side, working with a number of different businesses, but focus on construction, developers, and large property portfolios. insurance is a lot of fun to talk about these days. Everybody just gets really excited when we start talking insurance, but
Really?
oh yeah, you just get to talk about it. Yeah,
It's getting cheaper by the minute.
yeah. You ask me right now
That's a
what the
fairy
cost is. Right now, it'd be a little bit more expensive. No, it's becoming a very important important part, especially as we look at cash flow, and we look forward to talking to you guys about how that can impact your businesses as well as your partners. Fun fact: I think 7 starting businesses, and I do
It's
like
hard to
pizza.
top those two.
I know. I ran with the Bulls one time in
Ooh,
Pamplona,
that's
which was
fun.
just kind of neat.
Like in Spain,
so,
like the legit?
yeah, like it's legit. Like gotta be fashion the guy next to you.
That's cool.
But
Was it scary?
Yeah. Well, so we were kind of getting after it the whole night before. So yeah, we were
Still feeling the effects?
yeah. So we were having a good time, but yeah, I'm still here, and
That's awesome. Was this before you were in risk management?
way before. yeah. So do as I say, not as I do. sort of thing.
Exactly.
Yeah.
We've seen the Mythbusters, right, where they make the bull run through the china shop and he doesn't touch one piece of china.
Yeah.
That's
Yeah.
AI.
Yeah.
Maybe.
Yeah.
The bull has got AI. But I think the running the bull is slightly different, but that's cool.
That is awesome. Well, cool. Well, thank you guys for being here. Thank you all for being here. Let's just start off with some clear definition. So Suzanne, what is the difference between profit and cash flow?
Well, that's a geeky question. So if you're an accountant, which I am, fortunately, profit is more of like a paper number, and a lot goes into it that has nothing to do with cash. So amortization of goodwill, depreciation of assets, gain, losses on equipment, things like that. So there's a lot more that goes into that number than just pure cash. So you can have profit and you can have no cash. Or vice versa, you can have more cash and you can have no profit. And so part of our job with our clients is explaining to them the differences, because that is a very gray subject for them, because everyone thinks of profit and cash as like the same thing. And so we spend a good bit of our days explaining, no, even though you didn't make any money, you still owe taxes. And here's why, because that doesn't make any sense to a lot of people, why they owe a ton of taxes and they have no money in the bank. So we spend a lot of time talking about that.
I bet you do.
Phantom income.
Yes.
It's really bad.
It's a real thing.
It's a real thing. It's terrible.
So Scott, you wrote a whole book about cash flow. And so there's copies of the books on the tables there. So please bring home a copy. But the whole premise of the organization and the book, and really what your passion's about, is around cash flow, managing it, and how to leverage it. Can you share a little bit about why it's such an important issue and challenge for business owners, especially in these industries?
Yeah, I got a degree in food, hotel, hospitality management, and I sold timeshare, and then I opened a health and fitness company. So I learned the hard way of what cash flow was, the same way all of our customers and clients did, either in my own business or working with them on their businesses. And I would hear the pain, and I would think, profit, oh, look at this P&L, this is your money, this is awesome. And then someone introduced me to this other thing called a balance sheet, which I had no idea what that does. And then I learned that if you wanted either one of them, you'd rather have a balance sheet than a P&L to actually understand a business. And I'm like, whoa, this is insane. And so then a friend of mine called and said, let's create this lending company where we'll lend money to commercial contractors. And I was like, well, that's a terrible idea. My dad was a contractor, and he told me no one lends money to him. And so I'm like, okay, well, this balance sheet and income statement, we'll lend money. And next thing you know, I'm analyzing these income statements and seeing them with profit and thinking it's all cool. I'm like, this must be a great company. And then we'd lose a bunch of money, and we wouldn't help them. And we'd lose and they'd lose. And we fumbled around like that for 5 or 6 years. And so I was forced through tremendous amounts of pain to learn what they were. And so I realized that learning it the hard way next to our clients and in my own businesses or both was a real hard crash course. It wasn't just my business, but it was digging myself out of a hole
You
or
learned
not.
it way better than.
Yeah, and I learned it really well. And so I learned all this stuff. I learned these fancy words are hard to understand, and everyone sort of nods, and you feel stupid because you don't know it, so you don't ask. And then I was like, well, I hear all the questions. I'll start putting it out there. So I would bring people on and I'd ask questions, and Suzanne's been on. I'd do a webinar and I'd ask her all the dumb questions that no one wants to ask, but as soon as you feel comfortable, find someone you'd ask. So I'd ask her and she'd tell them. Next thing I know, I'm like, I'd read these books and you'd read the whole book and I actually know what it is. I'm like, but this is confusing. So I said, I'm just gonna write a very simple book that like spells out the basics. My goal was hopefully that people could read it and understand enough to like get into the ballpark to actually say, okay, now I understand some of these terms, these conversations. So that was the reason why.
Yeah, I love that, and Scott is available for signing the books afterwards.
I've given away way more than I sold, but the point of it was really just to have a resource.
Yeah, and I love what you talked about kind of learning those lessons on your own as a business owner, personally even. What is one thing for the folks in this room? What is one way that they know that they have a cash flow problem? Their organization. What are some of those key indicators before it gets too bad?
You don't sleep at night because you don't have any cash. That's the first indicator. That if you're not sleeping good because you're worried about cash.
Yeah, I heard this a lot. It was a common theme that I've heard from a lot of clients, and I've stolen it and used it. When you have a business you're in business, and you're now 2, 3, 4, 5, 6, 7 years in business, and your business has grown in top line revenue from a couple million to 5 million, or maybe it's 100%, 200%, 500%. You're now 5 or 6 times bigger than you were before, but you're still working for the same exact paycheck. You have a cash flow problem.
Yeah.
You either have a cash flow problem or you have an amazing balance sheet. So if you don't have a great balance sheet, you have a cash flow problem. And so the reason I say that is you're just not able to grasp those costs and where they are and utilizing them. And so you have just enough money to keep this payroll up, which is where your focus is, but you don't have enough money necessarily in the business to get ahead. And sometimes what happens is that could be because you brought on bad debt, or you had no margin, or maybe you had a bad project if it's construction, or had a bad customer. You just didn't know. There's a lot of reasons for it, but it's a good indicator that something's off in the cash flow business, aside from, like you said, just not being able to sleep. Bank accounts only got so much money in there at any given time.
Like if that's your whole focus,
Yeah.
We'll say with businesses a lot, what's your biggest challenge? I mean, out of their mouth will be cash flow, I mean, there's indicators for it, like Scott said, there's 1,000 metrics, but, if you're running a business, do you have a cash flow problem? So.
Yeah. And then, I'd love to hear from each of you, because we have, a unique group of professionals here, public accounting, mobilization funding, and then insurance. I'd love to hear from you all what you see in your industry and the folks that you work with as some of the best practices when it comes to managing cash flow. We'll start with you, Suzanne.
Oh, sure. Have a projection, have a budget, track it.
Stick to it?
Yeah, stick to it, and it changes. So sticking to it, that's loose, right? Because stuff comes up and you want to be nimble and you want to be able to change it, but you also have to know what your projections are and you have to know your numbers. So many people we sit with and say, okay, let me see your 12-week forecast, and they're like, my what? And you're like, really? You have no clue like how much you have to spend. You don't know what your cash burn is on a monthly basis. You don't, they don't know some of these metrics that are, super important to being able to manage cash flow. So, did I answer that?
Yeah.
I mean, I could go on. But.
Yes.
What I would add, Suzanne's right, having the cash flows. But what I'll make it bigger picture. If you can't forecast and just know where you're going in front of you with real data, it's hard to make decisions. So like imagine if you, just in your regular life, if you didn't know what was going on in the week and you had to make every decision with a gun to your head and you had 5 seconds to make it, make your best choice. Like you get in that fight or flight mode, it's literally impossible to make a good decision because all you're trying to do is survive. And so absent having like a 12-week cash flow or a projected cash flow, whether it's for a project or whether it's for your whole business or whether it's even just your own personal budget, you don't have a roadmap to get anywhere, so you can't proactively make a decision. Like you can't grasp, like obviously if there's a bucket or a duffel bag of money and you're trying to save 200 grand, you could go steal it and you got it, okay? But if you're trying to accumulate a few hundred grand of savings over a long period of time, you need to know like how long it's gonna take to get there, how much do I save per week? if I do this, this, and this, and let enough time go by, the wheel will spin off this much money, and I can park it somewhere. You can accumulate. Well, I think the business is the same way. So that's what that cash flow does. And then what we found in our business is we build a cash flow for ourselves. When we originally started to try to analyze the loan to see if we could make a loan and how we make a loan and how much does someone need. And the tool was, we'd always share it with our customer and say, here's the tool, this is what it looks like you need. And they'd be like, what is this? And we'd say, well, why do I have to borrow that much? Or can I borrow a little? I thought I needed 400,000, I really only need 100, why is that? And we're like, well, here it is. And they're like, wow. Or sometimes we'd give them this information and they would all of a sudden know like 10 things to do. They're like, hang on, you know what, I'm gonna go call that supplier, I'm gonna shop that, I'm gonna do this, and they would do it, and it'd be done. And all of a sudden, a lot of times they wouldn't even need a loan, or they would need less, or so I realized the information alone empowered them to who they thought they had no idea what cash flow was, but they knew all the decisions to make, and it was like, this is really cool. Like, you just give them, now, so we try to figure out, that's when we started focusing on cash flow.
Yeah, I literally sat with a client yesterday who is having cash flow problems. Good timing, but they're not the only one. But they, have their balance sheet out, and we're sitting there, and they're like, can you look at my balance sheet and tell me, what the issues are? So I just started asking questions, and Scott, you reminded me when you're talking about like terms with vendors and things like that. So I said, well, what are your, AR terms? What are your payable terms with your large, the people you spend the most money with? What are your terms with them? What is all this inventory? What's your AR, what's your inventory churn? Like, how often are you getting rid of inventory? And it, long story short, found out that they were, in order to save, 2%, they were overbuying inventory, which was then clogging up cash, because all their cash is sitting in this inventory that they save 2% on in order to, but they have this big order that they're not going to move for 120, maybe even longer days, because they bought so much of it. And I'm like, did that really save you 2% at the end of the day? Because now you have a cash flow problem, and now you're paying interest on this line of credit, which is way higher than the 2% that you're paying on this discard that you got on this discount. So paying attention to those kind of things, it just reminded me of that. Pay attention to your AR churn and your inventory churn and what are your payables? Can you negotiate higher terms with your suppliers? If you can get 90 days, then it bought you some time. And same thing on AR. If you can negotiate, 15-day terms with your customers, that's not always possible, but if you can, you definitely ask.
Yeah, and I would say I think insurance is definitely one of the things that you kind of put aside, because it's there, you need it. But most folks don't even have a plan for it, and we understand it's a cog of your cash flow. It's an expense of your cash flow, but having a game plan and understanding what that's going to be, but not just looking and saying, okay, we got to deal with this once a year, because most businesses, that's how they look at it, because that's how they looked at it in the past, and they've done it year over year over year. Those days are kind of going away, as you guys know, just from probably your auto insurance, your homeowners. It's not going down in many instances, especially where we live. We're in a much more elevated and quickly becoming increasingly higher insurance rates. So what we do is have a game plan. Work with your partners, work with your CPAs, work with your lenders, work with your attorneys. Have a game plan and understand what that's going to be throughout the year versus just at your renewal time. If you're planning on, okay, we meet 2 weeks for the renewal, we give a couple of different exposure updates a couple months before, and we're going to expect good results, that's just not going to happen. It's having a constant eye on the ball throughout the year and working with your advisor, your broker, whoever that may be, in conjunction with your other parts of your team, your extension of your team, that you have internally, to understand what ways can drive those costs, whether it's understanding if we have a large audit at the end of the year, is there ways to split that up throughout the year that we can save on what that big hit may be and spread out that cost. It's understanding where your claims are coming from. How much is that impacting your experienced workers' comp mod? Do you know what your workers' comp mod is? Most folks, you ask their visitors right now, what your mod is and how much of an impact that could impact your overall insurance costs, they'd have no idea. Let alone if you could ask them, hey, can you work with your broker? Do you know what it's going to be in a year? Well, you can project that out and understand what that looks like and give yourselves a better understanding of what those costs are going to look like. These are the things that we're helping clients do, and if you're sticking your head in the sand and just hoping for the best results, you're behind the 8 ball. So that's just some of the things that we're trying to help, and just getting a full picture, holistic view of what the impacts to your business are. And we know that insurance is just one of those cogs, but it's becoming a ever more important cog of your business.
Yeah, insurance is a great example though, because the increase in those costs will have a dramatic impact on what your overhead is that you're trying to layer in. It's not necessarily a project cost that you just automatically lay in. And if you can forecast, most projects are being bid, 6, 8 months, 9 months, 10 months, sometimes a year in advance. And if you bid them at a certain overhead allocation, and part of that overhead allocation is a significant portion is insurance, especially if you have workers' comp and general liability and umbrella policy and a lot of vehicles. Vehicle insurance and umbrella policies have gone up dramatically in the last year. So if all of a sudden you have like $100,000 of insurance premiums that now turn into $200,000, your percentages can be significantly impacted, which means it's gonna really hurt your cash flow.
It's gonna hurt your profit too.
It's gonna hurt your profit, but it's really gonna hurt your cash flow because you only have so much money coming off of that project in free cash that you have to layer in your overhead right away. You don't get retained, so it's gonna be tight. And if you don't plan for that, you're not bidding it correctly. You're now going into a bunch of jobs. Think of it like a pre-planned version of what happened when the supply chain went up so high. All of a sudden you bid these work and supply costs were way high. That was recognizable, but that can happen inside your business just with your insurance and other overhead allocations.
100%. And you're not making pizza girl margins, right? Not at all.
You can hide a lot in 55% margin.
No, yeah.
It still doesn't mean you don't want to keep it from your pocket either.
Exactly.
There's so many challenges to that industry though.
I bet. Scott, I think you touched a little bit on the tool that you talk about in your book, and I know it's on your website. Can you share it with the group and kind of just walk through why it's so important from like that planning stage, and understanding what kind of resources they need to manage their cash flow better?
Yeah, so from a construction perspective, and you can think of it as any work that you're trying to execute, I think what the tool does is, what we've found is most folks know there's 3 things that are key to the project cash flow, and most folks know 2 of them really well. They know how to bid, what their expenses, what their costs are, they have it on a sheet. And they also know what they've bid, what they've put into the project that should be the profit. And on top of that, they also know what the schedule is. Like, is it a 2-week project, is it a 2-month, a 4-month, how long should it take? And those are 2 key critical components. And if most projects were done, like started today, finished tomorrow, and paid the next day, what's on your bid sheet is what you'd make, right? You'd get it, but that just doesn't happen. So it's the third piece that's the most important. It's like, okay, if I have a $1 million job, for example, and there's $800,000 of cost, how much of that $800,000 do I have to spend before, and I like to use the word invest, prior to that $1 million coming to me, right? Like, how much of that million's come in, how much of the $800,000 has to go out? I'm gonna probably put more out than I get in the first month, but when or if does it even balance? And so if you had to invest the entire $800,000 to make a $200,000 profit, that's a different story than investing $200,000 into a job and then the job cash flows itself and you make a $200,000 profit. Those are 2 totally different jobs, but they look exactly the same on the bid sheet. That's what the project cash flow tool will tell you. It'll tell you what you're gonna have to do, and that's based on your supplier terms and how fast you're paid by your vendor and where you should go or could go make some changes. And in the most simplistic term, it'll tell you if you should do the job or not.
Yeah, if it makes sense.
Yeah, so I'll give you a great example. We had an HVAC contractor here in Tampa, $4.5 million project for Hillsborough County, paid in 45-day terms, which was good. 38% margin. Like, everybody would run into that job in a heartbeat, right? No problem. You don't know this?
Yeah, well, I don't know where you're going, but that's good margin, yes.
It's a great margin. I mean, everyone would take it. We build the cash flow out. They were gonna have to invest $2 million before they could get to cash flow positive. And that's okay, it's still great margin, you're gonna make your money, but they don't have $2 million. And so you can get out on this job And when you're gonna find that out is about 3 or 4 months into it, and all your suppliers, and the big chunk of it was because of the chillers, and the chillers and the coolers are expensive. There's also long lead times on them, there's a long supply chain, there's a lot of engineering, so they have a lot of pre-construction costs. The chillers are gonna take a while to get in. They're longer, you gotta pay, they have their supply chains, and so like, what are we gonna do? Like, well, I can't do the shuttle. I'm like, I know. We can't lend you $2 million on it. So, like, what do you do? And so that was a way for them to go figure that out. And they had some great options. So they went and were able to get some from us, and they would make better terms with the owner, and they could leverage a couple things. But you can do all that early. You can't do that when you're like halfway out there, like, I signed up for it. So that's what that tool will do. And it's it's just a spreadsheet, so that's all it is. It just gives you access to information in a very simple way that marries up to the way you already look at a project, i.e. the bid sheet and the work schedule.
Yeah, it's, I love the tool, I love that it's there on your website, and it gives a very simplistic way for you to make data-driven decisions, especially about a job or a PO if you're a manufacturer. Dylan, from the insurance side, obviously insurance is a large expense for most construction and manufacturers, specifically with general liability and work comp and umbrella. Can you share with us some a tangible example or story or a way that you have helped protect or leverage working capital for a client?
Sure. As you're looking at insurance, why do people buy insurance? Why do businesses buy insurance? To pay for claims when they occur. And when you're looking at that way, you're like, okay, when a claim occurs, what's going to go on? Is the carrier going to pay for those claims? Are they going to leave a large reserve for that claim out there? I mean, what the carrier would anticipate, or the adjuster would anticipate, would that claim to be closed out at? So we had a business who had a fairly large claim, but what it was being adjusted or reserved at was much larger than what our internal adjusters, our internal claims advocates were really planning on it to be. So this is actually before they were a client of ours. So we were looking at this claim, and we're kind of doing some research on it, and we're kind of scratching our head like, why is this reserve still out there? And they'd gone through multiple renewals with this large reserve. It was a $50,000 claim that had been paid out, but it was a $200,000 reserve. So when we were able to get our arms around it and actually get our internal claims folks, we were saying, hey, this could be closed out at a lot less than what it could. So that large reserve, it ended up being a $200,000 reserve, was on that claims report each year for the renewals. That was impacting their renewal each and every year. So they're paying it additionally more for their premium annually because this large claim was sitting out there. When we were able to get back in and say, getting our internal claims folks who speak the same language as the adjusters, understand the same, understand the claim and sort of that process, we're able to get them to close the claim out at a much lower rate, or much lower amount, which positively impacted their renewal. At the renewal, we were able to save them 15% year over year, which they had no idea what was happening. That was one claim. And you look at a business that has multiple claims that they just are kind of letting it out there. Hey, the carrier's going to take care of us. They're going to look out for our best interest. They're really not. If you're not holding their feet to the fire, you're not going to get the best results. So, understanding what those claims look like, having quarterly claims reviews with your claims team, understanding if we have a claim, is this going to happen again?
Can you explain that reserve issue, Dylan?
Yeah.
I didn't get that.
Yeah, sorry. So,
$20,000,
again,
what happened?
insurance nerd.
No, it's okay. I should know it probably. Like
So,
Scott said.
You
I'm
have.
ashamed I asked the question anyway. Sorry.
Yeah, no. So you have your incurred loss is what it's what's been paid and what's projected to be paid, or your reserve. So when you have, say for example, you have an auto accident, for example, and the initial payment to fix the vehicle, to pay for the third party who's injured, or their vehicle or something else was injured, that's the initial payment. But there could be extenuating circumstances where there's going to be following injuries, additional surgeries that are going to be associated with that auto claim that are going to be out there, not initially paid, but the reserve that will be paid.
So they charge you on that on your renewal?
They're looking at that total
Okay.
incurred loss,
Understand.
and if you can reduce that internal incurred loss,
The reserve, okay.
that reserve, that's gonna go a long way. And then, to kind of dovetail off of that, your workers' comp, most construction and manufacturers, your workers' comp is really the only thing, one of the only things you can control as relates to your insurance program, and really impacting that. Medical-only claims versus, time lost or indemnity claims, there's a big difference there. As soon as that carrier pays $1 on an indemnity claim, meaning somebody's out of work for some time, not just paying their medical bills, that claim is now an indemnity claim. Does anybody know how much that's impacting their mod versus a medical only? An indemnity claim is impacting their mod 70% more than if that claim is kept in medical only. Most businesses don't understand what that means or how much that's impacting them. And lo and behold, that claim is not only just for 1 year and it falls off, it's on there for 3 years. So if you have a indemnity claim and the majority of it's paid out medical, but maybe that employee's out for a couple days, well, now that's an indemnity claim. Could we have paid their salary for that amount of time? Could we have gotten back to work on a return to work program? Well, if we could have done those things, now that claim, it's a $15,000 claim or $10,000. Let's use not a CPA, easier numbers. $10,000 claim. We gave it medical only. Now it's That's a $30 or $3,000 claim versus 10. Now that's impacting your mod each and every year. So instead of going into a debit mod, you're more in a credit mod, and that drives down your costs each and every year. So good question.
Thank you.
Yeah, great question. Well, I wanted to open up to all of y'all. If you have any questions for the panel, we'd love to hear some great questions.
Could you talk a little bit more about mod and exactly what that means?
Yes. So another good question. Your mod is basically it's a multiple that goes with your insurance, with your workers' comp. So workers' comp is a pretty easy mathematical function. It's your rate for that class code. So if you're a roofer, it's a much higher class code than if you're a clerical worker. So it's taking that rate multiplied times your payroll. That gives you your basic premium. Okay, say it's $100,000, but you've had multiple claims, throughout the year, multiple these indemnity claims that are driving that mod higher. Every business starts at a 1 mod, meaning it's par for the course, essentially. So you have multiple claims or more claims than the carrier expects you to have. So if you have more claims, they expect you to have $100,000 worth of claims, you're a larger business, and you have $200,000 claims or $150,000 claims, it's a pretty easy math equation there. It would be 150,000 over 100,000, you're gonna have a 1.5 mod. That's simplifying a little bit, but that's gonna be multiplied times your basic premium. So if you had $100,000 worth of premium, but a 1.5 mod, that's $150,000 worth of actual premium to your business. But say, for example, you're having less claims. You're having $75,000 worth of claims versus what you expect. So your actual claims divided by your expected claims, they're actually less than what they would expect. So now you're at a 0.75 mod. So if your basic premium is 100,000, you multiply that up by your mod of 0.75. You're saving $25,000 a year by maintaining a credit mod or a better than what the industry average would look like.
So mod really is a way to just determine and drive risk related to insurance.
If you have more risk, your mod's going to get absurdly high. But if you can control your risk, you can drive those workers' comp costs very, very low, and you can be better than your competitors, and you can use that as you're bidding on jobs as well as hey, here's our mod. We're at a 0.82 mod. What are the other competitors coming in with? Well, because that's a great way to determine risk of the job. Or is it a more risky job, or is it a more risky firm that you're working with, or less risky firm? It means a lot, and it can impact your premium or expenses quite a bit.
And sorry, go ahead.
I was just saying, is that payroll par based on one payroll cycle or a month's worth of payroll, or what is it?
So they look at that, all of your workers' comp information is especially in the state of Florida, is promulgated by, again, very insurance nerd, the National Council on Compensation Insurance, or the NCCI, and they determine all the rates. So they look at all the rates, basically your payroll times your, looking at the claims. So they'll determine, all right, if you're a clerical, is it a 0.1 or is it a 0.18 rate this year or 0.16? It really drives those numbers. So they're looking at that on an annual basis, but again, claims stay on for a 3-year basis. So your rates and your mod are altered each and every year. They don't just maintain, if you're doing well, it's going to stay at a 0.75. That changes and fluctuates each year.
And to jump in here, typically it's looking at the company's annual payroll. So from an audit standpoint, sometimes, with those quarterly check-ins that you were
Sure.
talking about, if you know your payroll is going to differ significantly, let's say you estimated that exposure to be X amount of dollars, but it's significantly higher, to avoid a huge audit at the end that says you owe this much more money to the work comp carrier, having those conversations on a quarterly basis of, hey, what new projects are you working on? Are you hiring more people? How do we parse this out over the rest of the year so that you're not hit with a large audit?
Yeah, you're gonna have that. They're coming for your money anytime. So if we project here and we actually do this, well, they're coming for that
They're coming
additional
for it.
premium. But if we try to get a little bit more accurate on what our projection of payroll or revenue, whether on the liability side, we can get more accurate and parse that premium over a 12-month term versus at the end of that audit, when that audit is done, that premium is due in 30 days. So it can be a very, very large number, or you can say, hey, we can look for a more accurate number and try to project that over a fully annual term, which is a good way to not get whacked with a big audit number at the end of the year.
Gosh. Other questions? Yes.
If a business owner wanted to get started looking at their cash flow, where would they start? Because it can be a little daunting, even for those of us that went to school for stuff like that.
I always like to recommend getting with your professional circle of influence, whoever that is, your Scott or your Suzanne of the world, if you have a CPA or if you have an internal CFO, like you said, maybe that person doesn't know where to start either. Read Scott's book.
Go to YouTube.
Yeah, seriously, yeah.
There's a lot of stuff. There's so
Um,
much free information out
But
there.
hopefully you have a circle of influence that involves a CPA or another financial advisor that can help you get started with that and point you in the right direction.
Any other questions over here?
Do you have a question?
No, I don't wanna
Oh, go ahead.
really geek out on insurance. I was gonna ask you about OSIP and CSIP because we have to give them credits, but with our rates, which I never understood that. Why is that?
So they're
If they're
looking.
gonna grab this risk up here, that should be cheaper. They're doing it to save money, I assume, right?
They are. Yeah. So for those that know SIP or CSIP,
Yeah.
owner-controlled insurance program or a contractor-controlled insurance program, OSIP, CSIP. It's a way, if you're building a large structure or you're doing a large project, basically you're getting the owner, OSIP, or the contractor, the GC, CSIP, buying the entire insurance program for that project. So they're looking at it in law of large numbers, getting more exposure, you can drive that rate down. And again, they're putting your auto liability, your general liability, workers' comp. Once you zip on that project, they're buying that insurance. So they're asking you for credits because they're saying
They're using our risk.
they're using your risk. They're looking. They're trying to say, what would your cost be? Because those are really driven off of your exposure
So
and your
they're making
experience.
money on it.
It's a way to do it. There's a way to become more competitive as that project. Because if they didn't do it and they just did your traditional insurance sense, where the GC has their insurance, their subs have their insurance, and for a large project, each of those are paying for their portion. Well, they're looking at if a sub, for example, has less optimal experience. Well, they want to know, and they want to try to get those credits because they're looking at your experience and saying, we're going to be now paying for that if you're driving a loss. So they're looking at your rates or your exposure, your experience as what they can, potentially get a credit for, whether it be an OSIP or a CSIP. That's kind of a shortened version. We can go kind of
No,
off. That's
I don't wanna, yeah.
We'll have another panel discussion just on work comp.
yeah.
So So they're essentially diversifying their risk across multiple subs, and then they're saying, hey, we're taking ownership that if something, we know that if we're managing this and we're diversifying this risk, ideally we should be able to qualify for some sort of discount there. But also on the other end of that, if something goes wrong and more than one sub, something happens, then they could also be on the other side of that, correct?
You're on the hook for it versus, you know,
Does it affect our mod though?
your, if it's on that job, they will have a portion that will affect your mod.
It would, right?
Mhm.
Right.
Any other questions?
What would you say some low-hanging fruit is from a business perspective? And particularly now, probably with the increasing in interest rates, like before you have a line of credit at almost nothing, it was easy to just kind of lever. But where would you think some good debt is worth taking and just to keep some liquidity versus like equity lines, is it an easy answer, or kind of what are some low-hanging fruit pieces when you go into a business that you look at first?
Talk about that.
I can take it. Meet with your banker, so there's, or, you know, Scott, if he's your, you know, financer. But there's a lot of things you can do there. So again, I go back to my client that I met with yesterday. They have a line of credit and they just have money parked there and they don't pay it down. And so they're paying interest on a balance that's, you know, never moving, but they have cash in the bank. You know, so if you're looking at, like you said, low-hanging fruit, I looked at their balance sheet within minutes. I was like, you need to pay your credit line down because, you know, they have all this, they've got $800,000 in cash and, you know, $800,000 in the line. I'm like, you don't have to pay the whole thing down, but I mean, a line of credit is cash. It's pretty much cash. They're like, oh, I want the cushion. They don't, you know, they want to sleep at night. They got this cushion. And I'm like, well, your cushion is costing you like $12,000 a month in interest. You know, so I don't think the cushion is that important. Like, you need to pay down this, you know, this line of credit. So you want to, you know, a line of credit, the point of it is to, you know, jack it up, pay it down, jack it up, pay it down as needed. If you can't do that, then you have a problem. You know, you don't need a line of credit, you need a term loan. So getting with your banker, back to that, is, you know, maybe you need an equipment line, maybe you need an inventory line, maybe you need a couple different options for financing, not just a line of credit. You know, maybe you need different vehicles in order to get the cash flow that you need. Because if you're just parking money in line of credit, you need a term loan or something. You know, that's just not what line of credits are for. So again, low-hanging fruit is take a look at their balance sheet and, you know, where do they have money parked. In this case, like I said, that client had a lot of money parked in inventory. A lot of clients have money parked in AR, you know, old AR that's been sitting there, they're not turning over, they've got bad terms, it's,
You write off the AR, or you're,
well,
or
like
you
in the
just try to
case, so you've got to go do some collection efforts, because the first question I ask is, you know, what do you do for collections? What's your policy on collections? They're like, what? You know, and you're like, is anyone calling? Is anyone trying to chase his money down? Is any, you know, is it bad? You know, is, like, do you need to write it off? And sometimes they don't know the answer to those questions. Like, they don't have someone calling, they aren't chasing it down. And people, you know, I'm like, well, if people aren't paying you, you need to stop doing business with them. They're like continuing to do business with the people that aren't paying the money. You know, but these are low-hanging fruit, I'm not kidding. It sounds really obvious to all of us, but we see it, I see it every day. So to me, it's low-hanging fruit. If you have customers that aren't paying you, stop doing business with them. You know, or sit down and have a conversation with them. Hey, you're not, you know, we can't do business with you unless you pay us. These seem like stupid things, but happens every day.
One of the things I would say, to answer your question related to banks, whether it's regular bank, whether it's, I'll just say lenders in general, but traditional banks especially, if you have a traditional line of credit and you're not using it for the use and the way it was intended, which is a line of credit, you know, traditionally, like Suzanne said, use it, pay it down, use it, pay it down. So sometimes people are like, okay, but what's the cadence of that? Well, the cadence really would be, if you have a line of credit that's used for a month's worth of expenses, or to float a payroll between this one payroll a month to get from payroll to when you're paid, you wanna, even if you, like, let's just use a round number, you have $100,000 line of credit, and you use the $100,000 to make your payroll and maybe some miscellaneous expenses, and then you're paid $200,000 a week later. Some people would say, well, I know I'm gonna have another payroll in a week, and then I'm gonna need this other 100 to, like you said, I wanna stare at it. I like, makes you feel good, right?
It does, it makes them sleep better.
And so you don't make the payment to the line of credit. What I would tell you to do is pay the line of credit down to 0, make your little miscellaneous payments. When payroll comes, even if it's 3 or 4 days later, draw off the line of
Draw it
credit
again.
again.
Yep.
Use it when you need it. One, the lines of credit, the cost of that, those days add up. And second, you're showing the bank that you know what you're doing and how to use it, and you're using it the right way. If you just take a line of credit out, draw the whole thing out, and it's like parked there, even though you're making the payments and you're on time and your cash balances are great at the bank, when the bank looks at what they can look at, which would be how are you using this line, they're gonna just see the max principal out, only interest payments, and they're gonna get nervous. And nervous means questions, and questions means somebody's gonna find something. And it's hard to get comfortable. I see the bankers. And you don't. And it's not necessarily your relationship, banker. It's really the credit people at the bank who are then going to go lay the pressure on your banker, and then your banker's trying to walk back these things, and you kind of get put in a box. You want to avoid boxes. You'd be better off. And the other thing is, if something is wrong like that, you might be better off saying, "Hey, look, I just had a bad job, or I'm gonna be tight for a month or two. I'm gonna make interest-only payments on this line. Unless you guys have another option, it'd be great if I could get a term loan," and you like let them facilitate the part of the solution. Yeah, it's a really good thing to do. The worst thing you can do is not share the information because you worry they might or not. You don't want to do that. And the second thing is you want to use the loans however they're intended. But to really know that, particularly lines of credit, because right now what we're seeing, some of the worst things, pain you can be put in is when a bank gets nervous and shuts your line of credit down. Like I've seen many of businesses go out of business because
That
they
was
had.
big in 2009.
Yeah, they just shut it
But
down.
the other side of that though is not just shutting you down your line of credit, but not giving you more. Because if you're in growth mode and, to again, this point of you've got a line of credit that's just parked, and then you go ask for more money, they're like, well, why would we give you more money? Because you're not making any, you're not making any money because you've parked this line of credit. And so you're gonna have trouble getting more capital. You're gonna have trouble asking the bank, and they're not gonna give you any more money. Nobody's gonna give you any more money, if you can't prove that you can pay down what you already have. And so I think the flip side of that is, they may call it, but they also may not give you any more, and you're never gonna grow. So.
And the other thing I would say is if you do want to grow, which I think everybody does, and if you don't, you should, because if you're not growing, you're dying, right? That's a hard truth. There's no real stabilization. And so a lot of times folks are like, well, I don't want to take a loan out that I don't need, and that you shouldn't. But you should go get a relationship with a bank. And even if that means the smallest loan available that you don't need, you're just building reps in a relationship and how you use it. And it's a lot easier for a bank to give a customer a couple $100,000 when they've watched how they've used even $25,000. That those like skills are built in, and you now can feel more comfortable to lean in on something and analyze the numbers. You don't have to make so many decisions. You don't have to make the character decision at the same time you're trying to make a credit decision. Like, it's good, even if it's just a deposit relationship. You're like, I don't want to move my deposit to my bank, but you got to play the game with the lender, that's sort of the way to go, is what I'm saying. Help them, help you, but then hold them accountable to that too. Like, okay, I'm going to move that, but in 4 months I'm going to come back and I'm going to expect that you guys are not able to do this. Can I get those kind of commitments, that kind of stuff.
Awesome. Some great insights there. Parting thoughts, I just would love for each of you to share, one key takeaway that you want the audience to take away from this discussion, this panel, before we get into networking. Start with you.
Go
for it. No, I'd say just get out in front. Get out in front as much as you can. Again, I mentioned before, gone are the days where you kind of hope and wonder, what your insurance premiums are. If you work with your advisor, your broker, throughout the year, get a plan. Make sure you can understand and project what those costs are going to be 1 year, maybe even 2 years out down the road, because it'll help you as you project jobs you're working on. If you're in growth mode, if you want to go purchase a new facility, all these expenses, and if you are purchasing a new facility, understand what those costs may be from an insurance side, because what those costs may have been 2-3 years ago are not going to be the same cost today. So let your insurance folks be a part of those, maybe not the decision, but let them be part of that due diligence with you, because if not, and you decide to move forward, and then get your advisor, your insurance broker involved, they may have a different view from it than you may have had, what you thought it would have been a couple of years ago. So get out as much as you can and engage your insurance folks. I'd say 6 months in advance minimum of your renewal, just to get an idea. So, please get out in front of it because we're in a pretty tough market right now.
I was gonna say, I would,
Just don't steal mine.
yeah, the biggest takeaway, no, that's true. I don't think I'm gonna take it. The biggest takeaway I would have is I'd say, don't let your pride or insecurity or what you think you should know or not know keep you from asking a question. 9 times out of 10, you're not the only one answering that question or asking, wanting to know, number one, regardless of what people say or tell you or they put on the internet, number one. And number two, you're the only one that gets hurt if you don't ask. And third, if someone is or treats you bad for that, it's great because now you know you're never going to want to do business with them anyway. So like you really should be, you can't lose in that scenario.
Good filter.
Unless, I mean, you just can't lose in that scenario. The only way you lose is by not asking. So that would be my biggest takeaway. Because these things are important. You can see how critical some of these little nuanced decisions are can like cascade into like really big deals.
Mine is similar, but you didn't steal it. So,
So I don't want to owe you.
Yeah, it's similar though. So it's don't brainstorm in a box, don't strategize in a box. A lot of people make that mistake of like either thinking they know everything or they're scared to ask questions. And the best decisions and the best ideas come from groups, not usually from one person. And so surround yourself by people that are really smart and will be okay brainstorming and being stupid with you, by just tossing ideas around. Have a circle of influence that you trust, that are successful, that you can run ideas by. If you sit down with your banker, your insurance guy, your CPA, and you start pitching ideas and they stare at you blankly, they're probably not the right advisor for you. You should be able to have somebody that you can have collaborative discussions with on the daily basis. Things are changing all the time. Like, we just talked about this discussion of insurance. If you're not having that right now with your insurance agent, you have the wrong agent. If you're not talking to your CPA or your lender about these issues, you have the wrong circle. You've got to, so that would, I guess, be my biggest piece of advice, is just don't brainstorm and strategize in a box.
Yeah, find the people that are where you want to be.
Yeah.
Don't talk to your peer group. Like, go to the people that you're going to be completely
Step
uncomfortable
above.
to.
Yeah.
Yeah.
Those folks usually got there by asking those questions, and they're
Yeah.
nice, and they can help you. They
Successful
wanna help.
people aren't usually it's not always smarts, right? It's that they surrounded themselves by other smart people and they've leveraged that and they've asked the right questions and they've been vulnerable and made mistakes and not made the right decisions. Those are successful people. They're usually not super smart. They're,
I fit that box. I know what I know, and I know, more importantly, I know what I don't.
Which you don't know.
Yeah, and I can definitely say that's a strength that I've built over time through pain, for sure. That's not something I would have told you when I was 25 or 28, probably 30. But I can tell you I learned that from 40 on. Yeah, for sure.
Well, awesome. Well, thank you for being the smart people here and a great, great folks in our circle of influence. We really appreciate your time and hope you all got a lot out of it. So we'll end the panel discussion here. We'll enjoy some networking and food and drinks. So thank you all.
Thank you.